Hello and welcome to Camel Finance. I'm your boy Camel, and today we've got a little bit of a tricky one, but I'm going to do my best to explain it. We'll start with a question. How is it that the dollar can be going up like this? How is it that we're seeing such dollar strength when 80% of all dollars in existence were printed in the last 22 months? So we expanded the monetary supply in America from 4 trillion in January 2020 to 20 trillion in October 2021. Said another way, we are well over 20 trillion now. Here is the M2 supply of the United States. As you can see, over the last few years, we have gone completely vertical. So again, how is it that during a time of massive monetary expansion, we are seeing a strong dollar, or an apparently strong dollar? Isn't it true that we've got 8.5% inflation? And that inflation has been getting worse and worse and worse every month? Yes, it's true. And remember, if in March of 2022 it was 8.5%, that's 8.5% higher than the March prior. Meaning that if next March in 2023, inflation is, quote, only 2%, that is still 2% above the prior 8.5%. And of course, one last point to make before we get into explaining why. This is if you believe their numbers. Anyone that's watched this channel more than a couple of times will know that the real number is significantly above this. So if you haven't seen the CPI as a lie, go and watch that. And without further ado, let's explain why we've got this apparently strong dollar in the face of giant inflation and massive expansion of the monetary supply. In order to understand this, you need to first understand what the DXY is. The DXY is an index for the dollar. This is taken, I found this is from 2015, so don't quote me on the actual weights. There's a chart here we'll get to in a minute. Don't quote me on these actual weights. These are possibly need adjusting for today, but the point I'm trying to make is absolutely valid still. The dollar index is a geometrically averaged calculation of 6 currencies weighted against the US dollar. And the US dollar index originally was developed by the US Fed in '73 in order to provide an external bilateral trade weighted average value of the US dollar as it's freely floated against global currencies. So the DXY, when you're looking at this chart, is not just the dollar. This is the dollar index, and the dollar index also contains the euro, the Japanese yen, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. It's of note that this is set up because these were, at the time of setup, the most traded by volume against the dollar, these currencies. But since then, countries like Brazil and China have actually more trade than some of these, like the Swedish krona and the Swiss franc. So there's some debate about whether or not some of these should be removed from the index and replaced, or if additional countries and currencies should be added to this. But in terms of understanding, all you need to know is the DXY is an index, just like a stock index, except instead of containing a bunch of stocks by market cap, it contains these currencies by weight based on how much trade they do against the dollar. Again, don't quote me on the percentages here because this is a document from 2015. So when we look at the chart and say the dollar is doing well, the dollar is strong, what do we actually mean? We mean the dollar is strong relative to the other currencies in the basket, the other 6 currencies down here. And this is much like saying that if you have a herd of sick cows and they're all sick and dying, but one of them is larger than the rest and therefore is dying slightly slower, this would be akin to saying, well, isn't this a strong cow? If they're all dying and they're all sick, then they're all dying and they're all sick. That's basically what this DXY is. The dollar being the biggest is the biggest sick cow in the herd amongst a herd of dying sick cows. I've got here principles for navigating big debt crises. It says, while currency declines hurt importers and those with debts in foreign currencies, devaluations are stimulative for the economy and its asset markets, which is helpful during periods of economic weakness. So said a simpler way, When they devalue the currency, i.e. when they print it out of thin air, this can be stimulated for the economy and for asset markets, basically because they use it to prop them up, but also because they are priced now in a weaker currency, so it takes more units of that weaker currency to buy the same asset. Currency declines provide a boost to exports and profit margins, as they make a country's goods cheaper on international markets, and simultaneously they make imports more expensive, supporting domestic industries. Devaluations also cause assets to rise in value when measured against local currency. So let's break this down. So there's a question here. Why can't all these other nations just allow America to debase its currency? And the answer to that is they can't do it because it messes with import and export. It makes the pricing really difficult, and therefore it puts pressure on them to inflate their own currencies in order to keep the imports and export charges and exchange rates in check. All central banks hold on their reserves a basket of other nations' currencies. One of the reasons they do this is so that they can defend their currency where required. If a country wants to strengthen its currency against another currency, it can buy its currency up against the other currency. Or another way is it can sell the other nation's currency into the open market. So all central banks hold a basket of other nations' currencies so that they can do some level of currency defense and currency control to control the strength of their own currencies. So in summary, whilst you look at this chart and say, wow, isn't the dollar strong? The dollar is only the largest sick cow in a herd of sick and dying animals. What's worrying for the dollar? We are starting to see other nations move away from the dollar. Between 2013 and 2020, the Russian central banks have halved its dollar-denominated reserves, and in 2021 it revealed plans to completely ditch all dollar assets from the sovereign wealth fund and increase holdings in euro, yuan and gold instead. Russia is also moving away from accepting the dollar for its oil, so we are starting to see other countries move away from the dollar. And as more and more countries do this, and as they start to build more and more infrastructure and have more and more ability to move away from the dollar is almost certainly going to fail, just like all of these fiat currencies are going to fail. And so I hope this goes some way to helping understand the truth behind the dollar. Whilst this chart looks extremely bullish, you have to remember that this chart is only bullish relative to other faster dying currencies. Nothing can take from the fact that they have increased the monetary supply in a parabolic manner. Nothing can take from the fact that even by their own numbers, this inflation is incredibly severe. And you only have to stop and ask yourself, are things more expensive around you, to know that these currencies are getting weaker and weaker and weaker. If you found value here today, please hit that subscribe and like button, share this video around, and until next time, I'm your boy Camel. Take care.